Hello everyone, this is Syed Tahmid Alam, an undergrad student of economics. Today I am going to share some interesting insights on financial crisis and how to reform this. Let's know the keyword that we are gonna talk in this video. We will know about financial crisis, history of it, and the causes of financial crisis. Later, there's a model named currency crisis model. We'll talk about this as well. And there might be some question that whether a crisis be forecast earlier or not. We'll know the answer. And later, there might be some solutions and reforms that as we can take as a reform of financial crisis. Let's know an interesting fact about this. During the 2008 financial crisis, the US Federal Reserve took a program called TARP, which approximately held $205 billion dollars in asset, and it was equivalent to the McDonald's Corporation at that time. Now we'll know the definition of financial crisis. What is a financial crisis? Financial crisis is a situation where assets drop sharply in value. Businesses and consumers struggle to pay their debts and liquidity dries up. To brag about more about financial crisis, it's actually a severe disruption in the financial system, often characterized as a sharp decline in asset prices, widespread bank failures, and a credit crunch. And you would remember that one of the most notable examples of financial crisis was the 2008 global financial crisis. Later, we'll know about some other financial crises and histories. Let's talk about the history of financial crisis. Financial crises have had profound historical impacts on the economies. You must remember, or you must have read about the Great Depression of the 1930, which resulted in a 30% drop in the global GDP, and the stock market lost 90% of its value, which was huge in number. And later, in the 1997 Asian financial crisis caused Indonesian GDP to contract by over 30%. And the recent global crisis, not recent actually, in the 2008 global crisis led to a worldwide contraction with the GDP falling by 1% all over the world. As we have known the history, now know how financial crisis may occur. Financial crises can be triggered by various causes. For example, 2008 crisis was primarily caused by the burst of housing bubble and the subsequent supreme mortgage crisis. According to the IMF, International Monetary Fund, regulatory failures and excessive undertaking in the financial sector were key factors. There's a model called currency crisis model. The model focuses on the role of currency fluctuations in triggering financial crises. Currency crises occur when a country's exchange rate collapses or faces severe pressure. There are four models in currency crisis model: the first generation model, the second generation model, the third generation model, and the fourth generation model. Let me tell you what the first generation model emphasizes. This model emphasizes the importance of fiscal model and exchange rate regimes in preventing financial crisis. The second generation model emphasizes the significance of monetary policy and international capital flows in understanding and preventing financial crises. Later, the third generation model tells us the focus shifts to the vulnerabilities within the banking and financial sectors as a key factor in predicting and managing financial crises. We are towards now fourth generation model, which says the systematic risk and the interconnectedness of financial institutions as critical aspects of crisis analysis. So far, we have talked about the causes, the history of financial crisis, and a model named currency crisis model. Now, we have to come to a solution, or what are the we have to find out what are the solutions of financial crisis. The solution to financial crisis often involve regulatory reforms. And after the 2008 crisis, the Dodd-Frank Wall Street Reform and Consumer Protection Act was enacted in the US. It introduced numerous changes, including Volcker rule to limit property trading by banks. How to reform financial crisis? Reforms aim to prevent and manage financial crises. We have come to know that the Basel III framework, which introduced stricter capital and liquidity requirements for banks, is a significant example of international efforts to reform financial systems. After these discussions, this question may arise to your mind that can crisis be forecast? Or may we know about the crisis earlier so that we can take some precautionary measures? However, forecasting financial crisis is challenging. In the lead up to the 2008 financial crisis, most models failed to predict the timing and extent of the crisis. And credit rating agencies downgraded numerous mortgage backed securities only after the crisis had already happened. Also, we have seen a recent financial crisis in the 2020 after COVID-19 pandemic came for strict lockdowns, travel restrictions. It had a significant effect on the global supply chains, consumer demand, and financial markets. Investors became increasingly concerned about the economic consequences in the pandemic, leading to a sell-off in the stock market all over the world, and which ultimately led a big crisis all over the world. However, we are now reforming from the crisis, and the economies are growing all over the world. Thank you everyone for watching the video. If you have any queries or questions, you can comment below and subscribe for more updates. Tada!